Welcome back to the channel, everyone. Today, we're diving into a topic that's been buzzing in financial circles, a development that could reshape portfolios and send shockwaves through the market. We're talking about silver and specifically the explosive potential for it to reach and even surpass $80 an ounce. Now, I know that sounds like a bold claim, but stick with me. The data and the market dynamics are painting a very interesting picture, one that suggests the big players, the banks, and those shorting the market might be in for a rude awakening. For years, many have called silver the poor man's gold, but that label is becoming increasingly outdated. Silver is not just a precious metal, it's a critical industrial metal. This dual nature is at the very heart of the bull case we're about to unpack. Think about where our world is heading. The green energy revolution isn't a distant dream, it's happening right now. And what's at the core of this transition? Solar panels. Every single solar panel manufactured requires silver. As nations worldwide race to meet their climate goals, the demand for solar energy is skyrocketing. This isn't a small niche market anymore. We're talking about a massive global industrial shift, and silver is a non-negotiable ingredient. But it doesn't stop there. Let's talk about electric vehicles. The shift from internal combustion engines to EVs is another global megatrend. And guess what? EVs use significantly more silver than their traditional counterparts. It's in the complex electronics, the battery management systems, and the charging infrastructure. So as you see more EVs on the road, remember that each one is contributing to a growing sustained demand for physical silver. Then there's 5G technology, artificial intelligence, and the entire Internet of Things. All of these cutting-edge technologies rely on silver's superior conductivity and reliability. This industrial demand isn't speculative. It's locked in, it's growing, and it's relentless. Now, let's look at the other side of the equation, supply. Where does all this silver come from? The majority of silver is mined as a byproduct of other metals like lead, zinc, and copper. There are very few primary silver mines in the world. This means that silver production isn't as simple as just deciding to mine more. If the price of lead or zinc drops, miners might scale back operations, which in turn reduces the amount of silver being produced, regardless of how high silver's price goes. We're already seeing reports of declining ore grades and increasing production costs. It's getting harder and more expensive to pull silver out of the ground. So we have this incredible surge in industrial demand running head first into a constrained and inelastic supply. That, my friends, is a classic recipe for a price explosion. This brings us to the financial side of the market, which is where things get really fascinating. For a long time, the price of silver has been, let's say, heavily managed on the paper markets, like the COMEX. Large financial institutions, often referred to as the bullion banks, have held massive short positions. A short position is essentially a bet that the price of an asset will go down. By creating and selling vast amounts of paper contracts, far exceeding the actual physical silver available, they can exert significant downward pressure on the price. This has created a major disconnect between the price of paper silver and the reality of the physical market, where supply is tight and demand is soaring. But this game can't last forever. What happens when the demand for physical delivery starts to overwhelm the paper promises? We're already seeing signs of this. The inventories in major vaults like the COMEX and the London Bullion Market Association have been steadily draining. More and more investors, from large institutions to individual buyers, are demanding the real thing. They don't want a paper IOU. They want the physical bars and coins in their possession. This is the ultimate stress test for the paper market. Think of it like a game of musical chairs. There are 100 people dancing, but only 10 chairs. As long as the music is playing and everyone is just trading paper claims, it all seems fine. But the moment the music stops and everyone tries to claim a physical chair, or in this case, a physical ounce of silver, 90 people are going to be left empty-handed. That's the situation the short sellers are facing. They have sold claims to silver they don't actually have. If the price starts to rise rapidly, they will be forced to buy back their short positions at a much higher price to cover their losses. This is what's known as a short squeeze. A short squeeze creates a powerful feedback loop. Rising prices force shorts to buy, which pushes the prices even higher, forcing even more shorts to buy. It's a cascade of panic buying. And in a market as historically suppressed as silver, with such a strong physical supply and demand story, a short squeeze could be absolutely epic. This isn't just a theory. We've seen it happen in other assets. When the fundamentals finally break through the paper manipulation, the move can be violent and swift. So how do we get to $80? Let's do some simple math. The historical gold to silver ratio, which is the number of ounces of silver it takes to buy 1 ounce of gold, has averaged somewhere around 40 or 50 to 1. In ancient times, it was even lower. Right now, that ratio is sitting much higher, often in the 80s or 90s. If gold is trading at, say, $2,400 an ounce, a return to a more historically normal ratio of 40 to 1 would put the price of silver at $60. A return to 30 to 1, which many analysts believe is possible given the industrial demand, puts silver at 80. And this does not even account for a massive short squeeze or a monetary crisis where investors flock to silver as a safe haven asset. The big banks and the traders who are massively short silver are in a precarious position. They are betting against one of the strongest fundamental setups in the entire commodity space. They are betting against the green energy transition, the EV revolution, and the laws of supply and demand. Every day that physical silver leaves the vaults and goes into a solar panel, an EV, or an investor's safe, their position gets weaker. The foundation of their paper castle is crumbling. The total collapse they face isn't just about financial losses, though those would be monumental. It's about a collapse in credibility. It would expose the deep fracture between the paper markets and physical reality. For the average person, this represents a unique opportunity. While the big players are caught on the wrong side of the trade, there's a chance to position yourself on the right side of history. This isn't about getting rich quick. It's about understanding the powerful, long-term trends that are driving this market and protecting your wealth from the instability that a major market reset could cause. The path to $80 silver is paved with industrial demand, constrained supply, and a financial market stretched to its breaking point. The shorts are trapped, the physical market is tightening, and the world's need for silver is only going to grow. Keep your eyes on this space. The rumblings are getting louder, and the moment the dam breaks, you'll want to be on high ground. We are witnessing a potential turning point, not just for silver, but for the entire financial system. Thanks so much for tuning in today. If you found this analysis helpful, make sure to hit that like button and subscribe for more deep dives into the markets. I'd love to hear your thoughts in the comments below. Where do you see the price of silver heading? Until next time, stay informed and stay prepared.